Well, global stocks have been sitting out the rally since President-elect Trump's victory last week, as his America First agenda has sparked fears that tariffs will hit emerging markets. Joining us now is Calamos co-CIO Nick Niziolek. Calamos is a global investment firm with nearly $40 billion under management. Nick, given what we're facing, from the looks at least of an incoming Trump administration, is China pessimism overdone or about right?
I'd say compared to where we were 8 years ago, we're in a much different position. So obviously, as you mentioned, we're in this transition period. It remains to be seen exactly what is put in place. But that being said, we've already seen several China hardliners in prominent roles. So, but that being said, comparing to where we were 8 years ago, I would say that the skepticism around what President Trump will actually do and what this administration will do around China is a lot less than it was back then. I think the consensus is that we will see more tariffs, but we'll see a tougher stance, and therefore that's already kind of somewhat priced in the market. I'd also say compared to 8 years ago, supply chains have already begun to reorient. So we've seen this friendshoring, we've seen this nearshoring initiative, and as a result, supply chains are a lot more flexible. China GDP is less than 3% exposed to U.S. exports now, so less significant than it was before. And sentiment is a much different place, right? So 8 years ago, we had China stimulus that was really leading markets to 52-week highs. Today, it's the exact opposite. China equity markets sitting at 52-week lows, sentiment at what looks like all-time lows. So I'd say given the current expectations, the current sentiment, I think the risk is actually to the upside. That if the worst-case scenarios don't bake in, we could see a risk-on rally here.
So maybe the answer is none of the above, but for the folks playing at home, looking at ETFs in emerging markets, for example, is it more China versus India or China versus U.S.? So would a China ETF be an India market hedge or an S&P hedge?
I think you hit it on the head. It's definitely more a China versus India at this point in time. We definitely have seen capital flowing into India quite strongly over the last 4 to 5 years. At the same time, we've seen it flowing out of China. And as we look forward, I think you're going to continue to see that kind of relationship hold up, where as China does better, maybe some capital moves out of India and vice versa for short-term moves. But when I think about the long term, I think there's opportunities in both markets. And I think that, we could see a situation again in the coming years where we get more clarity around tariffs, more clarity around U.S.-China relations. And that's an opportunity for, both markets to really see better days ahead.
Seems to me one of the biggest wild cards here is Mexico, because you have USMCA. Mexico has surpassed China as the U.S.'s largest trading partner, as we have seen this deglobalization, supply chain diversification. India, too, I realize. But Mexico is also the neighbor to the south and the one that President-elect Trump has basically said, we're going to start closing some of these trade loopholes so players like China can't start dumping their products in through Mexico and bringing them in through the so-called back door. So I wonder whether you think that's investable, especially as you do see quite a few moves tied to the so-called Trump trade around the peso.
Yeah, no, I would agree with you. I think Mexico is a greater risk during this term of this administration than it was over the last period. I think they have been a great beneficiary of this reshoring and friendshoring initiative, and I think some of those loopholes may be closed. And so that is a market that we're definitely more cautious on. Whereas on the flip side, what we see in India and what we see in this kind of made in India phenomenon, I think we're much more confident with the outlook there and kind of the upside in that market.
How much does all of this hinge on a dollar that doesn't continue to strengthen?
I think a weak dollar is definitely beneficial to emerging markets, but that being said, it's not the only factor. So it's the reluctantly strong dollar or the resiliently strong dollar has been an impediment for EM returns and overseas market returns, and we would definitely favor a weaker dollar environment for that. But that being said, there's other factors as well, and that could be the relative valuation opportunities we see there, the stronger earnings growth that we're starting to see in some of these areas, and that ultimately emerging markets can do well in a more benign dollar environment as well.